I'm Alexandra McGuigan. I'm with 100 Women in Finance. We have a booth here, 112. So if you're interested in coming and talking to us, we'll be there later today. That's not why we're here, though, today. We're here to talk about differentiated hedge fund strategies in challenging macro environments. So please allow me to introduce my panelists today. So first of all, I actually haven't done it in the order up there, so you'll have to follow the names. But Steve Ho, founder and chief investment officer at Triata Capital, an investment management firm based in Hong Kong and Shenzhen, China. He's a strong believer in reinforcing fundamental investing by triangulating proprietary alternative data and has been investing for 20 plus years. Then we have at the other end, Damien Tan, who's a managing director at Cambridge Associates. He's based in Singapore and is the co-CIO of client portfolios with a specialization in hedge funds. And then right in the middle, we have Steve Zhang, and he is the CEO of UBIQUANT Asset Management. Again, 20 years plus experience, so a lot of experience on the stage today. He's based in Hong Kong, and UBIQUANT is a technology-driven management firm dedicated to discovering patterns and unlocking value. So three very different experts on the table, but as I said, decades of experience. And what we're talking about today is the differentiated strategies in the challenging macro environment. So I just wanted to give a quick recap on what's been happening in the macro environment in case anybody's been sleeping in the last 12 months. But obviously we had COVID-19, which seems a bit like a distant memory now, but actually it was only 12 months ago, and I remember in Singapore at the Formula One when Singapore really opened up again. So it's really not that long, and so this is still flushing through the system, and there are still effects on portfolios, I think. Then the second point would be the Russian-Ukraine war. So in February 2022, Russia invaded the Ukraine in the biggest attack on a European country since World War II. The invasion was met with international condemnation, and the fallout to this ensues. Then we have the end of quantitative easing. So it probably tells you how old I am, but I remember when someone was happy about fixing their rates at 5% and then they fell off a cliff for 10 years. So a period of more than 10 years where interest rates were held artificially low. And this has obviously now changed very quickly. In March 2022, inflation surged and the Fed shifted course and rapidly started raising rates through the remainder of 2022 into 2023. Now, loan holders are finding themselves with interest rates having doubled, if not more. So we have to see what the ramifications of that is in the markets. Then, most recently, we have the Hamas attacks on Israel, obviously very fresh, and we don't know what the political fallout of that is going to be in terms of relations and neighbouring countries. And then finally, probably the big thing today is the meeting with Biden and President 𝐲𝐥𝐻𝐿. So what is that actually going to mean for China-US relations? So a lot to talk about, a difficult environment to navigate portfolios. So I want to talk about managing different investment styles. So let's start with Sean. And from a fundamental and alternative data perspective, how do you manage to operate in such a tumultuous environment and with all of these unknowns? How do you find and capture alpha?
Yeah, so at Triata Capital, we're definitely very focused from a bottom-up perspective, very deep fundamental in terms of our research team, our alternative data team. So with a very fast-changing macro environment, we always try to stay humble, stay truthful to our finding is. We oftentimes look at company itself from the management perspective, like our investment team, data team, we're in Shenzhen on the ground in China, trying to really understand what's going on the truth ground, using our alternative data and big data, trying to triangulate different information to understand various companies in terms of competition. Right? So to give you an example, during the COVID period in the last 2-3 years, a lot of restaurants that have been facing a lot of challenges in this environment. And oftentimes during the earning calls, there will be a hey, it's during COVID period. That's why the earnings are not great, the revenues are not great, etc. But for us, we're able to triangulate using various alternative data, big data, trying to understand more details within each of the stores, who's are winning more market share, who's are losing market share, what is the competition like, if they open a new store, what is the payback period, what is the table turnover, etc. Really trying to understand more detail about what's going on the ground. So a lot of these data for us, instead of finding the correlation versus the stock price, we care a lot more on the causality, right? So for us, in terms of our deep fundamental research, we always want to understand what is causing what factor, and how does it affect or underwrite in terms of our thesis to really have a differentiated view versus the market, right? Where can we see the opportunity both on the long and short side? Right, so at Triata Capital, our vision is always using a combination of alternative data, trying to stay more objective, at the same time trying to stay truthful to our deep fundamental long-term investment philosophy landscape.
Awesome, thank you. And so Damien, you get to, working at Cambridge, you get to see lots of different things. You see what's happening in lots of institutional investors' portfolios, but you're also working with lots of different hedge fund managers. So maybe you can talk through some of the strategies that have worked in these different environments and the challenges that you've seen.
Sure. Hi, everybody. Yeah, so we built and manage hedge fund portfolios for our clients, and clearly from that we do see a range of strategies. And I would say that the main sort of factor that has been driving performance is the interest rate regime, which is probably not a surprise. But you can see from data that when interest rates are rising, hedge fund strategies in general have mixed performance. Just take 2022, for example, equities and credit hedge fund indices were all negative. And probably the only hedge fund strategy that did well was global macro strategies. But when rates are high, and they remain high historically, hedge funds do better, both on an absolute as well as beta-adjusted basis. So, I would say that if, rates remain levels near where they are today, strategies that, could do well would be distressed or credit strategies, simply because financial conditions are tighter, and so there will be more opportunities in that space, plus yields are higher. Even amongst long-short equity, when financial conditions are tighter, there will be more winners and losers, and that helps fundamental stock pickers. And even in global macro, when they did well last year, I think that when rates remain high, there are opportunities for relative value trades, for volatility trades, and that it could be a good environment for them as well.
Great, thank you. And Steve, do you want to talk about maybe from a quant perspective, how rising interest rates, how this has affected your strategy?
Oh, sure. Good morning, everybody. My name is Steve Zhang. I'm representing UBIQUANT, which is a Beijing-based quantitative hedge fund manager investing mostly in Asian equities. We manage about 11 billion. We've been around for more than 10 years. I guess just to answer what Alexandra has mentioned about the evolving or rising rates environment, we don't necessarily worry that much about the market's involvements. It's more about what kind of liquidity we are entering, and or the market is giving us, and also over the longer term whether our quantitative methodologies are generating alpha. So these are very different in different market environment, but we're also sort of adaptive and just trying to make sure that every year, even whatever market changes, it's not necessarily affecting us, or we are still having our cutting edge technology in terms of quantitative investments. So this is what we have, over the years achieved. we hope that we will continue to generate 10 plus annualized alpha over the longer term, but over the past decade, we actually achieved much higher than that. I guess that's really just based on a couple of things. One is we were fortunate investing in the Chinese market, which I guess Joe and Anthony during their previous panel actually talked a little bit about it. It's more of it's a big market. It's not necessarily generating the kind of beta you wanted to over the past, I guess, 2 decades. But on the other hand, it's liquid. It has a lot of participants, and also, I guess, in terms of the names that are being traded in that specific market, there are over 5,000 stocks that are there, and all of them are offering you the kind of liquidity and I guess the magnitude or the participants of the investors are very different from the likes of the United States or Japan, which are much more, I guess, efficient. So that is a good place for, I guess, quantitative managers to generate good returns and alpha. And over the years, we have developed and grown to be a pretty sizable one that helped us to develop, additional capabilities in terms of having, I guess, better human capital, higher AI technology, better machine learning capabilities, and really just, adapting to, I guess, in China and outside China, and hopefully we will continue to generate the kind of good returns in this rising, I guess, rate environment.
Excellent, thank you. So now I want to change course a little bit and move to the topic of war, because we've had a peaceful period, and then all of a sudden, recently, some obviously significant geopolitical issues. So Russia's invasion of the Ukraine, obviously, which still persists, and now the attack of Israel and the fallout of that. And I was just recently in Dubai at the AIM conference, and I heard Mohammed El-Erian say that the longer things persist, the more likely contagion is. And the more likely contagion is, the more likely a recession is. So what do you think about that, and how do you think it's going to affect the portfolios? I might start with Damien this time.
Sure. Wars are terrible from a humanitarian perspective, but from a investment perspective, if you look at it historically, equity markets in the immediate aftermath of a war generally fall on average about 8%, but they recover pretty quickly. Within a month, most of them recover. I mean, the most recent situation in Israel was a similar story. And I would think that, the impact of war is probably more muted on the investment environment compared to the impact of the economy. Mm-hmm. So if you look at it in the past, where wars coincided with recessionary periods, then the so-called contagion or the effect lasted longer. And the way we think about portfolio construction, to your question, is that you just have to remain diversified across strategies, diversified across geographies, and as long as that conflict does not become too global or too widespread, usually it's fairly contained.
Yeah, and Steve, what about the war and the effect on electronic trading? Are there increased risks that you need to manage for in this environment, or how do you, if your data is then subject or one of the countries gets involved somehow, how do you manage that?
I'm not sure whether I hear your question clearly because there's some echo, but let me just try to answer. I guess in the current evolving, I guess the market environment, with the war, and I guess the Fed is not necessarily stopping because the inflation is still to some extent elevated or not necessarily meeting their 2% target. We are, I guess just looking for ways to, I guess, keep evolving or advancing our current technology capabilities and also looking for other markets to trade. So China obviously is pretty sizable, it's big, as I mentioned, but there are many other markets that we were looking for opportunities as well. We start with Asia, and some of the markets, including Korea, Japan, Taiwan, and Hong Kong, are the areas that we're starting to look into placing investments, and really just for the two purposes. One is we wanted to diversify our capabilities and just the overall portfolio. We do have a lot of in China. China is less efficient, but it's to some extent saturated as well for quantitative strategies. So there are Japan and Korea and probably other developed markets that we can look into to deploy our similar strategies and for the purpose of generating additional alpha and diversifying our overall portfolio. And also we understand that the world needs all kinds of strategies. As Damien mentioned, there are credit, there are equity long short, there are events, there are also quantitative managers. And I guess I was an allocator for probably 20 years. So at the time I was looking for all kinds of investments. I wanted diversification. Diversification means that alpha generation will be on a standalone basis will be strong, but in the meantime they are uncorrelated to each other. So what we're offering hopefully would be, I guess, on a standalone basis is the kind of alpha that we will continue to provide, which will be stable. And in the meantime, whatever alpha we're providing will be very different from, I guess, the likes of that are being provided by, for example, Zhang or US managers or credit managers. And on a portfolio basis, it makes sense to add a little bit exposure to us.
Thank you. And then, Sean, from a fundamental perspective, how does the war affect your portfolio?
Yeah, so just to echo what Damien was saying, I think for the war, it's bad from a humanitarian perspective. But really, in terms of our portfolio, I think we probably take a different approach versus the two other managers. So instead of being diversified, we actually want to be concentrated and zoom into focus in terms of our long investment. So from a fundamental investment perspective, right, for us, we think the biggest risk is not the volatility, because the volatility is merely outcome of what people traded the share price or company at, but more in terms of permanent loss of capital. Right? So what that means for us is when your thesis starting to change, or you don't understand your portfolio company deep enough, fundamental enough, that something's starting to change and you're not able to capture that. So I think the biggest risk within fundamental investing is you probably double down on your wrong idea, because oftentimes you don't know what you don't know within your knowledge space. Right? So for us, how we try to avoid some of these mistakes is, first of all, take a very team-based approach in terms of how we look at investment. We have regular IC meetings where we like our investment analysts challenge each other on investment names. We actually look at a lot of alternative data, by collecting by ourselves, looking at more from an objective matter, trying to see if our theses are continuing to work out or because of any macro environment that actually starting to deviate away. And we're actually trying to stay true to our findings. And if we're wrong, we're happy to admit we're wrong and try to cut loss and stay away. But if we're correct and we get a better opportunity to add in terms of our core longs, we are very happy to do that and are happy to double down. So we view a lot of these volatility, both risks and opportunity, and that's generally our approach.
Excellent, thank you. And now to the big meeting today. So I think everybody's kind of waiting to see what the outcome is. How do you plan for the future in order to capture opportunities, and how do you think that the meeting today between Biden and Xi Jinping is going to affect your portfolios? You can start again. We'll go back down this way.
Yeah, so in terms of the opportunity sectors, I actually echo Steve was saying. We believe for Triata Capital, we are a Greater China focused fund. So we believe there's tons of opportunities within China itself, both on the long and short side. Right? It is right now the second biggest economy, continue to grow. There's definitely different headwinds, tailwinds, etc. But for us, when you zoom into company specific, there's a lot of different opportunities, and especially within China, because there's a lot of business that's evolving very quickly, a lot of new innovation, technology that's coming on board. Oftentimes, we'll run various studies, right? Like this year, AI been a very hot topic. A lot of people, I'm sure a lot of firms have been doing a lot of research around it. For us, we actually had a lot of debate, right? All the way from the hardware segment to the tech giant that creates the LLM model, all the way down to the internet platform players that's potentially able to implement a lot of these LLM model. What does it mean for the whole eco chain, right? What does it mean for each individual company? How much cost can they potentially save down the road? If you look at companies in a 5 to 10 year horizon, I believe there's a lot of unknowns within a lot of these companies. We talk to people from Alibaba, Tencent, who are in the AI unit, try to understand what do they plan for the future. A lot of them, they don't even know what sort of product they might potentially roll out. So at the end of the day, we think about how do we price this into our financial model? What does it mean for our target price, et cetera? So we always try to stay humble, try to learn more about the industry and find the different opportunity sets. And also in China, there's a lot of evolving moving part as well, right? If you look at, for example, food delivery, it's getting more adapted. What does it mean for the restaurants? What does it mean for some of the super chain market? You know, Double 11 just passed by in China. You can see the parcel of volume been record high, increasing 23% year over year, continue adaptation more online. What does it mean for various players within the industry, et cetera? EV cars, that's also a big topic. You see China been one of the big market that's been adapting electric vehicle with different tier cities. Adaptation rate is 25% to 40% plus. We definitely think that space will have a big potential to grow. But at the same time, there's a lot of competition, right? There's more than 90 plus brands within China competing within the same space, heavy capex industry. What does it mean for some of the tail players? Are they eventually going to lose out, become bankrupt? What does it mean for some of the top players? Are they become more global players? What we're seeing, one thing in China right now is a lot of consumer brand. They actually become more global, right? So not only they're starting to do well within China, they're able to expand overseas with better innovation, with better brand recognition, et cetera. So we think there is a tremendous opportunity when you look into detail of various companies.
Absolutely. And then Steve, what are the differences between China and global markets from a quant perspective?
I guess I wanted to answer
Sure.
the previous question first,
Yeah,
and
sure,
then
sure.
move on to this one. I guess in addition to what Zhang has mentioned, the last time President Xi visited the United States was 6 years ago. And I guess the expectation, at least from our perspective, would be that it will get back to where it was 6 years ago. So that's the kind of expectation, hope, and which is pretty much just normalization. So these two biggest economies in the world, the past few years were not very healthy. I guess not just for the sake of themselves and also for the sake of the whole world. So for business people, we're hoping that there's going to be a way for these two countries to work together proactively and also practically. So that will, I guess, hopefully bring back to where it was in 2017. And back then, I guess, just giving you an example why, as a quantitative manager, we would care much about it. For example, the daily volume in China currently is roughly 700 billion RMB, which is much lower than I guess, the historical average of 1 trillion every day. And that's the reason of, a lot of institutional investors are not necessarily actively investing or trading in China, mainly because they didn't think, it's going to make money for them, especially fundamental guys or long-only guys. And we need a market liquidity. We need a market efficiency, both from the fundamental perspective and the quantitative perspective. And as long as, I guess, the economy is in check, it's growing, FDI is coming back, and global investors are coming and participating, then we will see a healthy Chinese market. And that's something very important to us, and I guess also very important to all the financial participants as well. So that's, I guess, a part of the reason we really hope or are having higher expectations that the relationship between the U.S. and China hopefully will get warmer from here. So that's just to I guess, to answer the first half of the question of the previous question. Just in terms of the difference between China and the global markets, we've been in China for a long time, and frankly, we're being pretty successful. I guess now we are trying to develop our growth trajectory all outside China. And there are a lot of differences. I mean, there are talent differences. There are, I guess, market differences as well. As I mentioned, the new markets, Japan, US, Korea, all these are the new markets to us. And we will try to see whether our technology or our capabilities will be useful or efficient in these markets. So that's a gradual experience. And also, since we are coming out of China, we're competing directly with the global market leaders. So they don't necessarily care, whether we've been in China for so many years, because from the allocators' perspective, especially the large asset owners, they will treat everybody more or less the same. So we're really just competing with the biggest of the biggest in the space, and we wanted to be generating hopefully good return, but in the meantime, a controlled volatility, so that our Sharpe ratio hopefully will be a unique, but in the meantime a pretty attractive Sharpe ratio. And also in the meantime, as we expand, we're looking for global talents as well, because in the past the vast majority of our talents or people are, I guess, Chinese, and there are a lot of quantitative portfolio managers and investment professionals, or even fundamental investment professionals we can look into and see whether there are any ones that make sense for us to bring in-house and help us to continue to grow and compete with global competitors.
Excellent, thank you. And Damien, I should have given you all the chance to answer the first question. so let's talk about the outcome for today's meeting and from your perspective, and how that might affect some of the hedge fund managers that you're working with.
Yeah. I mean, the US-China decoupling or de-risking is actually quite rapid. And, if you look at China's share of US imports, that has gone to 2005 levels. And today, the US imports more from Mexico than China. And China exports more to Southeast Asia than the US and Europe combined. So, it's really been rapid. But regardless of how the meeting goes today, if you look at China equity valuations, they are actually near historical lows, single-digit percentiles, PE valuations, both on an absolute basis as well as relative to the broader equity index. So, from a valuations perspective, you would say that China equity long-short managers would have good opportunities, and those with good beta. But I would also say that, do also look beyond Asia. ASEAN, India are benefiting from that de-risking agenda. More broadly, I think, in terms of portfolio construction for hedge funds, I would say, unless you don't worry too much about volatility, like Sean alluded to, and then you can have just concentrated portfolios. I would say portfolios you should play both offense and defense. Offense meaning, invest in strategies that have beta exposure, whether it's credit, whether it's distress, whether it's China equities, whether it's healthcare sector-focused long-short equities, to give you that beta exposure, to give you that yield, to give you that return, but also play some defense and invest in, funds and strategies that have a track record of lower volatility, lower correlations with markets, more downside protection. And I think that kind of diversified portfolio is probably more important today than ever, given how uncertain macro environments can be.
Well, then that was going to be my last question, because we've only got 5 minutes left. But I was going to say, how do you actually prepare your portfolios for the unknown, given everything that's happened in the last 12 months? Like, we obviously can't time markets, or you're pretty lucky if you can. But how do you prepare for the unknown?
So for us, I think one important thing is keep in mind to know where your edge is, where you're good at, and where you're not. Right, so really stay truthful to where you think you can generate most of the alpha and be zoom in focus on that. So for us, it's really from a fundamental bottom-up perspective, more on the longer term horizon. So we try to stay truthful to our strategy, been very focused on the greater China opportunity sets, understanding the company inside out, etc. And try not to be disturbed by the outside noise, some of the volatility, the sentiment-driven, the changes, but stay more truthful to the competition landscape, to our thesis, and see if it continue to play out, and also trying to be objective along the way. And then we think eventually you'll generate both alpha from the long and short side, and you'll win on the game. Excellent. And Steve, protect from the unknown?
Sure. I guess the past 12 months have been a pretty robust, I guess, in terms of performance for us. But what's going to happen in future? As I mentioned, we're doing a number of things. Really just trying to hope that we will continue the kind of success of the kind of alpha generation capabilities that we have achieved. So some of the new markets we're entering into, obviously it's relatively contained or careful because these are not necessarily the kind of markets that we're familiar with. So it takes time for us to really test our alpha models to showcase and just both to the clients and to ourselves that this markets have been working for us. And in the meantime, we're exploring other strategies as well. So really just with the expectation that longer term we wanted to achieve this 10 plus alpha, and over the years we have achieved much more than that. But we are also realistic. We want to meet the global standard because 10 plus is something that as long as we can continue to achieve that for the next, let's say, 12 months or 20 months, 24 months and beyond, then we hope that we will be much more institutionalized and attract global asset owners' attention. I guess in terms of some of the I guess areas that we're looking into or data, because onshore data they are very much focused on, I guess, onshore. What I mean onshore is onshore China. It's very much focused on price volume, and offshore there are a lot of alternative data. Satellite data, there are credit card data. All these data are just different source of, I guess, additional information or alpha that we can hopefully add to our current alpha database. And these are the areas that we're exploring actively, and they are very different from what we have been doing. And these are things that we think over the longer term will be healthy for our growth.
Excellent. And Damien, other than diversification, anything that you can do to prepare for the unknown?
Yeah, I mean, I would just add two further points to sort of playing offense and defense. I think it's important to know your risk tolerance, what kind of volatility you can or cannot tolerate, and then construct a portfolio from that perspective, and also be aware of your liquidity needs, because hedge funds, different strategies have different liquidity profiles, and you don't want to be caught where you actually need the liquidity, and when something unexpected happens and you cannot have the cash if you needed it.
And then one final, very last quick question. What keeps you up at night, Damien?
Really, if you have built a portfolio that is fairly stress tested and robust, then really nothing much.
Good.
Yeah, I think the key is to be nimble yet patient. That sounds contradictory, but be nimble in terms of looking for opportunities, whether it's strategies for the environment or whether hard to access managers are closed and they suddenly open. But be patient, because understand what you're investing in. It can be for the long term certain strategies, so don't be too shaken by day-to-day events.
Steve, what keeps you up?
I used to check Bloomberg terminals all the time, and I guess that was before my quantitative days. Now I guess it's less relevant, but there are other relevant things that keeps me up at night. I guess the likes of, I guess, whether the alpha signal has been performing, and what kind of leverage we are actually employing, and whether there is, let's say, a kind of meltdown in the quantitative space. All these will keep you alert. But in the meantime, just like Damien said, if you have a stable, robust portfolio, then usually you feel comfortable evolving and, I guess, just going through the whole market environment or market cycle. But in the meantime, I guess just the kind of leverage, the kind of, I guess, stop loss, or the whole risk management system that you're employing, hopefully it's good enough for you to really just to be adaptive to today's market environment, which is very it's changing very fast. So that's something we really spend a lot of time building. And offshore we have a little bit more leverage, which means that our risk parameter is more comprehensive. And these are, I guess, the areas that we're focusing on.
Great. And Sean, something keeps you up?
Yeah, so in terms of the risk perspective, contrary to a lot of the managers, we oftentimes really care about the company itself. So instead of the macro environment changes, we want to understand how does that change in terms of our long portfolio, our investment portfolio, does it have any change, etc. So we often go through the full IC meeting to discuss about different stress test scenario. So oftentimes we are prepared and understanding our portfolio inside out for that. But I think one thing that's potential risk is with this AI rise, with there's more and more autonomous in terms of learning. Like we often try to think, how does that will affect the whole financial industry, right? What does that mean for, from junior analyst to the portfolio manager? What does that mean in terms of human understanding, in terms of the financial industry, and what's your strength and how do you leverage that technology?
So it's just my children that keeps me up at night. So thank you to our speakers very much. We have to end the session now.